In some ways they have absolutely increased. We've watched gold and silver decline pretty much on a consistent basis over the last 4 weeks, especially if you look at a weekly chart. It started by the lead up with the expectation that the hike coming up, which of course occurred earlier this month, would be a 0.5%, and it might be followed by another 0.5%. But it was a couple of things that came out during the statement, as well as Chairman Powell's interview at the conclusion of the FOMC meeting, which didn't raise more ifs, but more wonderment as to whether or not the Federal Reserve can actually have a handle in curtailing inflation. One of the wild cards was they pretty much assured the public that there would be a series of 0.5% rate hikes when Powell said, we haven't taken 0.5% rate hikes out of the picture for the last or for the next couple of FOMC meetings. And the word couple, of course, indicated that they're probably going to raise interest rates a full percentage, half in June and half in the July FOMC meeting. That really started the financial markets tumbling. Of course, we've witnessed consecutive declines in the S&P here, the Dow Jones Industrial, the NASDAQ, and the fact that we had follow through again today, that surprised me. I thought maybe we would see the market go into a oversold scenario and we'd even have a dead cat bounce, so to speak, or some kind of base forming, and that didn't happen. We had dramatic declines, about 3% plus with the NASDAQ. I think the NASDAQ composite declined about 4%. We had the cryptocurrencies crashing hard. Bitcoin was down about 12%. So if you put gold's performance today relative to 3% declines minimum in equities, cryptocurrencies absolutely getting devastated. And then you look at the fact that gold declined by 1.5%, that almost seems tepid compared to the other financial markets. Of course, yields have been rising on U.S. debt, treasuries, and bonds. The dollar has gone to a high that we haven't seen in, I believe, in about a year, 2 years, since the first part of 2020. So that's the series of ifs that have increased. In a way, they've been answered, but the big if is whether or not these moves will curtail spiraling inflation. CPI for March came out at 8.5%, and the forecast for Wednesday's CPI for last month are mixed. You had an article in Forbes saying it would come in between 8.1 and 8.5, which would show it's either stabilized at 8.5 or diminished slightly. And then Bloomberg quoted a New York Fed survey in which they think it's going to be hotter than 8.5. So you don't have a unanimous forecast amongst economists and amongst the individuals that various news sources have been following and quoting. And so it leaves a lot of uncertainty as to what that number will be. I think it could be 8.4, but it could also be 8.6. I don't see it varying that much from the 8.5 we saw last month. And the rationale that I have is the primary causes of inflation, which are right now supply chain issues that are really keeping goods in demand and not being able to fulfill those orders, and also the uptick in the COVID-19 cases in China, in which they have been really shutting cities down or parts of these cities down. And that, of course, is going to continue to pressure inflation and the war in Ukraine. So those are all things that the Federal Reserve has absolutely no control over. They can contract the U.S. economy, but they can't address supply chain issues. They can't address the war in Ukraine, nor what's going on in China, whether or not shipments are coming out on time, or that creates a greater bottleneck. And that's where the additional uncertainty comes in.
Hey, absolutely great points. The Fed can't control the supply side of what's happening with the inflation there. But has the Fed's latest rate hike changed the case to hold precious metals?
It has, in a roundabout way, because what Fed action has done has been affecting the yields of US debt instruments. And when yields go up, that really strengthens the dollar. And it also makes gold and silver as an inflationary hedge less attractive because it doesn't yield any kind of interest payments on it.
Now, Gary, gold revisited its record high in March due to the Russia Ukraine war breaking out, speculating a bit here, but closed the month under 2000. It has since gone under 1900. How do you see gold's path from here on out, technically?
I can I'll discuss different levels we're looking at, but I think the answer to that question, excuse me, will only be answered once we have the most current CPI inflation data out. Because if the data comes in hot or higher than 8.5%, on one hand, higher levels of inflation are very bullish for the precious metals, specifically gold more than silver. Silver can be under more pressure because of the industrial applications, but we've had this double edged sword. As inflationary pressures grew, the idea that the Fed would get more aggressive also grew. And so, Fed measures by raising rates is extremely bearish in terms of the force it puts on the precious metals, and the reciprocal inflationary pressures can have extremely bullish undertones. So it's excuse me, well, so it's a combination of that push and pull that really creates the uncertainty. I'm not even going to venture to guess if it will find support. We have the first level of support at about 1850. I believe currently gold is trading about 1853. 1836 is the 200-day moving average, and I think that that is the most important and critical technical level that must be held if we want to say that gold on a very long-term basis is still in a correction, but a bullish pullback. In other words, we're getting this downside of pricing within a bullish market,